Donald Trump is back in the White House. With his return comes a familiar refrain: tariffs. Tomorrow, April 2nd, 2025, marks the enactment of a new wave of tariffs on imports. Trump has dubbed it Liberation Day, claiming these tariffs will revitalize American manufacturing. The primary targets are familiar as well: China, Mexico, and the European Union. The most impactful of these new tariffs is a 25% levy on all foreign-made vehicles, a move sure to send shockwaves through the global auto industry. The global economy, still recovering from the COVID-19 pandemic, is on shaky ground. These new tariffs threaten to further destabilize the global market with potentially disastrous consequences. The immediate impact of the tariffs will be felt in the rising cost of goods. Imported cars will become more expensive as the 25% tariff drives up prices. The auto insurance industry is bracing for a surge in claims costs. Repairs will become more expensive as imported car parts become subject to the new tariffs. The housing market will not be spared either. Tariffs on imported steel and lumber will drive up the cost of construction, making it more expensive to build and repair homes. This translates to higher rebuilding costs for homeowners insurance. Perhaps the most concerning aspect of these tariffs is their impact on healthcare. Tariffs on medical devices and pharmaceuticals will inevitably lead to higher healthcare costs. The insurance industry is no stranger to challenges, yet the Trump tariffs present a unique set of challenges, forcing insurers to reevaluate their risk models and business strategies. The immediate concern is the impact of rising costs on claims. For auto insurers, the 25% tariff on imported cars is a major concern. Many popular car models rely heavily on imported parts, making repairs significantly more expensive. Homeowners insurance will also feel the heat. The tariffs on steel and lumber will increase the cost of rebuilding homes after disasters. The most immediate impact of the tariffs on consumers will be felt in their wallets. Insurance premiums across all lines of business are expected to rise as insurers adjust to the new reality of higher claims costs. Auto insurance premiums, already on the rise in recent years due to factors like distracted driving and more expensive vehicle technology, are likely to see some of the most significant increases. Homeowners insurance premiums are also likely to climb. The tariffs on building materials will make it more expensive to rebuild homes after disasters, leading to higher claims costs for insurers. Health insurance, already a significant financial burden for many Americans, is likely to become even less affordable. Tariffs on medical devices and pharmaceuticals will increase the cost of healthcare, forcing health insurers to raise premiums. This will leave many Americans with the difficult choice of paying higher premiums, absorbing higher out-of-pocket costs, or foregoing health insurance altogether. The tariffs are not just impacting the cost of goods and services, they are also injecting a significant degree of volatility into the global market. This volatility poses a significant challenge for insurance companies, which rely heavily on investment income to maintain profitability. Insurers typically invest their premiums and reserves in a diversified portfolio of assets, including stocks, bonds, and real estate. However, the tariffs have introduced a level of uncertainty that makes it difficult to predict market movements and manage risk effectively. The stock market, often a barometer for investor confidence, has already reacted negatively to the tariffs. The S&P 500 is down significantly year to date, and analysts are lowering their year-end targets. For insurers with significant stock market investments, these losses can eat into profits and reduce their ability to pay claims. The bond market is also feeling the pressure. Bond yields, which move inversely to prices, have been fluctuating wildly as investors weigh the potential impact of the tariffs on inflation and interest rates. The impact of Trump's tariffs extends far beyond American shores. The targeted countries, China, Mexico, and the European Union, are all major players in the global economy. Retaliatory tariffs are almost a certainty, as these countries seek to protect their own industries and economies. This tit-for-tat escalation could quickly spiral into a full-scale trade war, with devastating consequences for global trade and investment. The European Union, already grappling with the economic fallout from Brexit, is particularly vulnerable to the tariffs. China, with its massive manufacturing capacity and growing economic might, is better positioned to weather the storm but is unlikely to back down from a trade fight. China has already imposed retaliatory tariffs on American goods in response to previous rounds of Trump tariffs and is likely to do so again. The tariffs are also creating uncertainty for global reinsurance hubs like London, Zurich, and Singapore. The reimposition of tariffs marks a turning point in the global trade landscape. The insurance industry, deeply embedded in the global economy, faces a future fraught with uncertainty. The immediate challenges are clear rising claims costs, volatile investment markets, and the threat of a full-scale trade war. However, the long-term implications of these tariffs are far more difficult to predict. The insurance industry, known for its ability to adapt and innovate, will need to draw on all its resources to navigate this new era of protectionism and uncertainty. One of the most significant challenges facing the industry is the potential for a prolonged trade war. If the targeted countries respond with retaliatory tariffs, as is widely expected, it could trigger a tit-for-tat escalation that could drag on for years. This would create a climate of extreme uncertainty, making it difficult for insurers to forecast losses, price risk accurately, and manage their investment portfolios effectively.